This is your LMAX Exchange technical update for Tuesday, June 20th, 2017. Euro dollar. So the euro continues to show signs of stalling out off that 2017 high that we saw in the previous week, just shy of 113. If the market breaks down now below 111.10 and establishes a daily close below that level, it will open the door for a more significant correction to the downside towards a measured move which comes in around the 109.25 area. If we get down towards 109.25 following that 111.10 break, that would probably be an ideal level to see the next higher low in continuation or in anticipation of a continuation of what has been a clear uptrend in 2017 off plus 14-year lows down in January at 103.41. So if we break down below 111.10, there's the possibility that it opens a deeper setback correction towards the 109.25 area, at which point the market could then look for a higher low and continuation of gains back towards next key critical resistance in the form of the August 2016 high at 113.67 further up. Only at this point back below 108.40, a previous higher low, would negate the constructive outlook for euro dollar. Sterling dollar. So cable is pulled back below some significant previous resistance at 127.75, with the market having been defined on the top side by that level for several months off the plus 30-year low that we saw back in October of 2016 that had defined the top of that range before finally breaking out above 127.75 in the month of April, which set the stage for a significant structural shift to the top side, exposing an eventual move up towards a measured move extension in the 135 area. But right now we're in the process of this consolidation and potential correction, which could easily extend back towards the 125 area before the market looks to resume its upside momentum and trade eventually towards that 135 objective. It would take at this point a break back below 123.60, that low from the 10th of April, to take the immediate pressure off the top side. Dollar yen. So dollar yen has seen a nice bounce over the past several sessions, but overall this is a market that has been very well capped into rallies, and certainly while it holds below a recent high at 112.13, there's risk for another topside failure and more immediate bearish resumption back towards the 2017 low just shy of 108. It would take a break above 114.37, that's the high that we saw on the 11th of May, to negate the current downside pressure. Euro Swiss. So Euro Swiss continues to trade very well capped below that psychological barrier at 110, and while the market holds below that 110 barrier, there is risk for a continuation of downside pressure that would take us down below some key support right now, which comes in the 106 lower 106 area. At this point it would take a break above 110 to take the immediate pressure off the top side and potentially force a more significant shift in the structure. Aussie dollar. So Aussie has been coming up to trade into some key resistance around the 76 area over the past few sessions, but has been unable to really establish above 76, which suggests that this market into this sort of critical medium-term resistance zone between 76 and 78 could stall out yet again in favor of a resumption of declines, eventually all the way back down to the low that we saw back in May, that 73.30 low, which would see an acceleration if we saw a break below that level. A daily close above 76 would, however, negate the immediate downside pressure or the prospect thereof and open the door for a push higher up towards the medium-term resistance in the 77.50 to 78 area. Dollar CAD. So dollar CAD is attempting to consolidate off recent lows following some intense setbacks off the 2017 high just shy of 138. Ultimately, if the market does trade lower, it's expected to be very well supported down to the 130 area, with the medium to longer term trend still favoring the top side and the formation of a higher low ahead of a bullish resumption. Look for a break and close back above recent resistance around the 133.09 area or 133.10 area to confirm the possibility for a higher low and accelerate gains eventually back towards a retest of that 2017 high at 137.94. Only a close below 130 would negate the more constructive outlook for dollar CAD. Kiwi dollar. So the New Zealand dollar has rallied up significantly over the past several days off that 2017 low around 68.20, but there is evidence of the market wanting to stall out after trading back above 73, and a breakdown and close below some recent support around 71.85 would strengthen this outlook and open the door for, again, a resumption of declines back down potentially towards and below that 2017 low at 68.18. SPX 500. The S&P 500 continues with its run of fresh record highs, and following the breakout that we saw above 2400 several days back, that set the stage for a measured move extension towards 2480 further up. That follows that the move that we had seen off the previous record high that was in place in 2017 for March at 2400 down to a correction at 2320. That's 80 points. And so the breakout above 2400 is projecting that move up towards the 2480 area over the coming days. At this point, a break back below 2400 would be required at a minimum to alleviate immediate topside pressures. Gold. So gold retains its constructive outlook, putting in a series of higher lows and higher highs since bottoming out in 2016, with the market most recently pushing up to a fresh 2017 high just shy of 1300. And so these setbacks, although they've looked to be intense over the past several days, are viewed as corrective while the market holds above the previous confirmed higher low around 1215. Ideally, these setbacks should be supported in the 1230s in favor of a higher low and resumption of gains beyond 1296 and towards the 1375 2016 peak further up. Only a close back below 1215 would compromise the constructive outlook for gold.